Right now, if you want to compete in the war for talent, you have to be in a location where the millennial generation wants to be. And as Rick alluded to, that is in a place where everything is at the fingertips of your employee base.
Many in that millennial group have never written a check, never bought a newspaper. They don't understand why they have to use a plastic card to get in and out of their building or a key to get out into their apartment. Likely because of this group, real estate innovation and technology is accelerating at a very rapid pace. One large employer in New York City currently reviewing their headquarter options for a possible relocation recently polled their employees on where they'd like to be within the city. And no kidding, they literally disregarded all of the responses from all the non-millennials within the organization, focusing only on those in the 20 and 30-year-old category.
I think WeWork is probably still a tenant that we would be very comfortable with, and we are comfortable with in many of our projects, because I still can envision the space being turned into regular office space. Now, if you're changing the physical side of a residential building by making micro units, etc., it's going to be harder for us to underwrite that, to really see where is this trend going and what happens if it doesn't work.
U.S. property owners have historically lagged behind those in Europe and other parts of the world in terms of enthusiasm for the adoption of change, innovation, and technology. And I can't exactly say why that is, other than perhaps U.S. property sectors have by and large been relatively successful until now without having to. But importantly, while there is still a long way to go, it does appear to be changing now as U.S. property owners have been working hard to identify and employ innovation and technology to create the efficiencies and enhance the building experience. The U.S.'s strong innovation ecosystem, both the relative availability of venture capital and a mature tech startup culture, should fuel the trend in the coming years.
It's a default to look at the gateway cities, and I think you need to, and there's a reason why they're highly liquid. I'd say but as you start to look at the U.S. markets, you should pay attention to the broader U.S. markets, because there's going to be certain things in the other cities there that are going to be performance cities, we believe. And again, back to this notion of redefining really what core real estate is. I think you'll make a mistake if you come to the U.S. and think there's only 3 cities to invest in.
So even industry-based cities that are in secondary markets have some serious potential.
Follow the underlying demand drivers, and it's a broader market, and we're starting to see performance and cap rates that are very urban in places like Nashville and others. And so it's
San
really
Antonio.
to look at the broader U.S. market.
Gateway cities were down 23% versus 3% for all other markets.
I think we're absolutely following the trend towards a much broader scope of cities, as we call the 18-hour cities in the States, which is a term that I personally like.
The 18-hour
the
cities.
18-hour cities
I like
rather
that.
than the 24-hour cities. But I think just in the 15 years that I've been in the States, I think these cities have changed tremendously. And I think, while maybe in the past it's been New York and LA and San Francisco, Boston, now if you go to these other markets, Nashville, Austin, San Antonio, Denver, Minneapolis, places that some people in Europe maybe are not as familiar with, but it's amazing how these cities have shifted, and how the work-live play element that our colleagues talked about is fully in force in these markets as well. And so for us, it's clearly following these trends and really looking into the micro-specifics of a specific university, a school, a hospital, a military base. All these can be triggers for a successful investment. And then most importantly, liquidity. So if our colleague who is from Seattle is still there, I'm happy to sit with you afterwards. We've been trying for 2 years to buy something in Seattle, and there's just nothing there, and it's ultra competitive. So that's...
He's going to leave his card at the front.
Okay, perfect. Thank you.
In the U.S., if our clients are looking at Denver, Boulder, Austin, we will look at those deals, because we want, we are very client led. And so I think you have to be. You can't just, focus on the key gateway cities. You have to be a little bit open and be case by case.
As you are well aware, the Chinese investors have hit the pause button because of China's capital export regulation, and quite frankly, we expect to see that continue into 2018.
The capital markets is still very, very deep. I mean, the allocation to real estate is up. We see new entrants. We've got the Japanese coming back into the market. We've got many of the sovereign funds who are not fully invested in their allocations yet.
We're working a lot with Asian investors that are looking at Europe, but they're also looking at the U.S. And I think the U.S. is a bit is such a dynamic market. We're able to originate mezzanine loans in the U.S., which in Europe we have not been able to originate. It's very, the cap rates are so low, it just doesn't support mezz. So with a lot of our Asian investors that are investing in equity in Europe, they are choosing mezz in the U.S.
Corporates are healthy, tax incentives have boosted their performances, and quite frankly, this is a very good sign for the future of real estate.